Roku, a Kathy Woods favorite, is now down 64% year to date. And the question is it cheap enough to now consider adding into our portfolios? That's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel. Let's dive right into this one. So you can see here that Roku is now down 64% year to date. And part of that is that we've seen digital advertising come down in the second half of this year so far. And Roku had a tough Q2 where they released results that were not in line with analyst estimates. So what exactly happened? Well, you can see that Roku swung to a second quarter loss on slower ad spending. And so, of course, those shares declined after hours as the results missed those analysts' expectations. And let's dive further into that. So you can see that Roku said that expected two of its main drivers, advertising and sales of streaming hardware, to come under further pressure during the second half of the year, which of course would cause the share price to decline. And the share price actually did decline 25% in after hours trading when they reported their Q2 earnings. They did say that they're in an economic environment defined by recessionary fears, inflationary pressures, rising interest rates, and ongoing supply chain disruptions. That's effectively what every company is saying right now. We just have a slowdown. But here's the interesting point. They noted that they also believe that consumer discretionary spend will continue to moderate, pressuring both Roku TV and Roku player sales. So it's not just advertising revenues that they feel are going to be pressured, it's also the sale of the hardware. The company said that it expected to make approximately $700 million in revenue during the third quarter. Now, just keep in mind, guys, that is a sequential increase, I think around 3 or 4% from third quarter of last year. So this is not seriously bad news, but the company did withdraw its full year revenue growth rate estimate, citing of course that there's uncertainty and volatility in the current macro environment. But I actually dug into the Q2 results, and I actually don't think that it's as bad as people are making it out to be. I think that there's certain levers that management can pull to bring the profit back up. And this is what I mean. Notice that Roku had some wins in the second quarter. They added 1.8 million incremental accounts to reach 63.1 million accounts at the end of Q2. Now, here's the interesting point. Notice that revenue growth remains robust because total net revenue grew at 18% year over year for Q2, but the earnings decline was due to manageable costs. Notice how research and development and sales and marketing are up 74% and 97%. So you can absolutely believe that there's going to be some cuts here to sort of restructure these departments to be more in line with the rate at which revenue is growing. So managements or the CFOs will be looking to protect their profits in this environment, and that's exactly what I think is going to happen with Roku going forward for the rest of this year. And you can see that their outlook for Q3 is $700 million of net revenue. They do expect to continue to pull in a loss for Q3 of $190 million of net income and $75 million in adjusted EBITDA. It just takes time to turn this ship around and operate leaner, and I do believe that they are moving in that direction. And overall, you can see that revenue has grown significantly over the past 6 years. This is why people like Kathy Woods have been so bullish on this company. And note at the bottom there that Roku reached its first year of profitability in fiscal year 2021. However, the reason why I'm not as bullish on Roku as Kathy Woods is simple. As I was doing the analysis on Roku last year, when I saw how bullish Kathy Woods was on it, I actually bought a device and sort of played around with it. I hated it, and here's why. And it's just my perspective, but the reason why I didn't like it is that although you're getting free content, it's interrupting your movie to serve that content. That being said, I do believe that there's a lot of ingenuity, a lot of product development going into the CTV space. Ultimately, you're going to have to move in a direction where you are not interrupting the viewer experience. In fact, you might have a in-screen advertisement playing while the movie is going on, or actually products being inserted into the background or the foreground of the particular scene that's being watched. So that's how this really works. And I think you got Microsoft working on it, you got the ad tech space working on it, and you got Roku working on it. So I do believe that that's a direction that this industry is going to go. And so a share price decline of 64% could be a good time to buy up the security depending on what the ultimate valuation looks like. And it's very important to note that the thesis remains the same. Pay TV is on the decline. And so in 2026, it will decline from over 50% as it stands in 2022 to 40% in 2026. Personally, I cut the cord back in 2005 and I ended up getting a Netflix subscription. But I'm also from the generation where any piece of media that we ever wanted to get, we got access to over the internet in one way or another. Now notice that TV and ad budget spending has not grown in line with the time spent on streaming by consumers. So this is another part of the overall thesis that consumers are spending more time on these platforms and advertising has not caught up. However, with more and more companies diving into this space, I think it just makes it more important to advertisers to follow in the space in line with the growth that the space is experiencing. Now, where exactly do I believe that revenues for Roku are going to go into the future? Well, growth is expected to slow down even beyond the 2022 weakness. So notice that in 2022, I'm just growing at around 12%. It comes back in 2023, but beyond that, I'm growing revenues at a slower rate. So 15% in 2025, and then beyond 2028, only at 10%. So that will be much lower than sort of what the Kathy Woods of the world would be expecting for this company. And I totally am okay with being pessimistic or not as optimistic on this space as others may necessarily be. And so before I dive into the valuation, I just want to remind you guys that 80% of the viewers of this channel are not subscribed. So please take a second and subscribe to the channel right now so that you don't miss out on more great content. Now let's go into the valuation. So you can see here that the free cash flow per share valuation is approximately $100 per share. But be careful because you got to watch that stock-based compensation. I have not made a free cash flow per share net valuation. And so you have to forecast out what you believe stock-based compensation is going to be and reduce that from the free cash flow to come up with a real valuation. I haven't done that in this case. And note that they continue to maintain an excess amount of cash on their balance sheet. It's $2 billion compared to their market cap of $9 billion. So that's a real benefit to the ultimate valuation of the company. Now, as you can imagine, there's more and more competition coming into the space. Netflix is going to be launching an ad-supported tier, so is Disney. So what does Roku think about more and more competition entering the space? And you'll be surprised with what they think. Well, you can see here that what I just mentioned, it was mentioned in this article. Roku will soon face competition for streaming ad dollars from two major competitors, which is Netflix and Disney. But notice that Roku's chief executive, Anthony Wood, said that he believes that the new entrants to the market would complement Roku by making streaming ads an even greater draw for advertisers. And that is my belief as well. With companies like Netflix and Disney moving into ads, it makes streaming ads even more mainstream, which is a very refreshing sort of take on this. Now, he also says that the current ad market upheaval is cyclical. We are in an economic cycle where advertising is trending down. It will turn around, he said during a call with the analysts of the Q2 call. Now, you'll be surprised where Roku is in terms of its overall valuation relative to its intrinsic value compared to the other opportunities on our tracker. Well, you can see that Roku is starting to get very cheap while being an industry leader of a very disruptive technology. But in order to get that $100 per share valuation, notice that I did not take into account the share-based compensation, so you do have to deduct that from the free cash flow per share when you come up with your valuation. You might actually end up at $100 per share valuation depending on how you change the valuation inputs, but I just want to really point that out to you guys. Now, another opportunity that I did highlight on this channel that focuses on digital ad revenues is Warner Brothers Discovery, and you can get to that video right here.